Ecoworld Berhad is a Malaysian investment holding company specializing in acquiring, developing and managing real estate assets established in Malaysia. For your information, Ecoworld has involved in two business sectors, which are property development and investment holding. The property development division is responsible for developing residential and commercial properties, while the investment holding division is primarily involved in managing and operating real estate properties. Ecoworld not only operates in Malaysia, but it also operates in Singapore, the United Kingdom and Australia. There are 3% primarily owned the corporation, which are Tan Sri Abdul Rashid Abdul Manaf, Tan Sri Datuk Sri Leo Kesin, and Datuk Leong Kok Wah. In short, Ecoworld Berhad works in 3 economic zones and is now involved in roughly 20 development projects, including new township, integrated commercial complexes, luxury high-rise residentials, and green business park. That's the short introduction of Ecoworld Berhad. Next, we move on to the industrial analysis of Ecoworld Berhad. On this part, our group going to analyze Ecoworld using the SWOT analysis. From here, we will get to know Ecoworld's strength, weaknesses, opportunity, and threat. For the strength, Ecoworld Berhad has a well-defined organizational structure that clearly outlines the line of reporting as well as the individual department's accountability and obligation. Likewise, the board of directors and its several board developers, Ecoworld Berhad has been able to sell homes at a precedented rate, demonstrating purchasers' faith in the management team's strong brand. Thirdly, large land bank Ecoworld Berhad is presently in the middle of a corporate exercise that would increase its land bank from 1,300 to 4,400 acres. Finally, creative product offers. Due to its enormous land bank, Ecoworld Berhad may provide novel goods via township development. Next, for the weaknesses, they are facing an increasing cost of construction phase. The ability of the group to achieve the desired profitability is directly affected by the cost of construction. A major component of cost of construction is building materials, such as steel bars, bricks, cement and steel reinforcement mesh. These components are subject to price fluctuations. Due to the increasing costs, actual construction costs are closely monitored and tracked against project budgets. As for the opportunities is on demographics. The young and rising workforce will continue to sustain property demand, particularly in Greater KL, Kuala Lumpur, and employment center. Second is migration. The Malaysia government's goal of increasing greater scale population to 10 million by 2020 will be a key demand driver for Ecoworld. Lastly is for the threat. Ecoworld has the weak market sentiment. The group's performance is dependent on the performance of the property market. The demand for the properties at the 3 regions that the group operates in the Klang-Li, Penang and Johor could be affected by weaknesses in domestic and international economic environment, changes in government policies and also tightening of bank lending policies and oversupply. Due to this, the group will continue to focus on landed properties and affordable housing where demand is still resilient.
Now, let's go through financial analysis. As you can see in the slide, total non-current asset of Ecoworld Development is increased slightly from 58.4% in 2018 to 60.3% in 2019 and continue to rise to 66.7% in 2020. We figure it out, it is due to investment in joint venture. In this financial statement line item, the percentage is increasing year by year, starting from 10.7% in 2018, 11.3% in 2019 and 12.6% in 2020. This is due to an incremental in share of post-acquisition results and reserves by 138.5 million ringgit and elimination of unrealized income by 41.5 million ringgit. Another factor is trade and other receivable, in which it is increased significantly from 6.5% in 2018 to 8.2% in 2019 and continue rising to 9.6% in 2020. This is because the long-term trade receivables are due from house buyers and amounts due from joint venture are not expected to be settled within the next 12 months. In overall, total non-current assets in 2020 is the highest compared to another 2 years. Current assets shows a declining trend from 41.6% to 39.7% in 2018 and 2019 respectively, and slowly decreased to 33.3% in 2020. This is due to the percentage of property development costs dropped from 24.6% in 2018 to 0% in 2019 and remain the same for the following year. In 2018, property development costs solely presented in the statement of financial position. Meanwhile, in 2019 and 2020, property development cost is reclassified as inventories, which it is measured at the lower of cost and net realizable value. Now, this explains very well how there is a percentage in 2018 but then dropped to 0% in 2019 and 2020. In overall, another financial statement line items did not give much impact to the current asset, as there is no big difference of the percentage within 3 years' time. In terms of total equity, there is increase significantly from 42.3% to 42.5% in 2018 and 2019 respectively, and continued to rise to 45.1% in 2020, perhaps due to retained earnings. The percentage of retained earnings is increased from 5.9% in 2018 to 7% in 2019 and continued rising to 8.5% in 2020. We noted that the retained earnings in 2020 is the highest, basically due to dividend. Next, share capital shows a declining trend from 34.7% in 2018 to 33.8% in 2019 and continued rising to 34.9% in 2020. In overall, other line items did not show a big difference within 3 years' time. Next, non-current liabilities shows a declining pattern from 18.8% in 2018 to 15.8% in 2020. Loans and borrowings recorded a huge drop, which is 18.5% in 2018 to 16.9% in 2019 and continued its pattern to 12.2% in 2020. This is mainly due to the group's and the company's exposure to liquidity risk. In conclusion, Ecoworld recorded the lowest percentage in 2020, which it indicates the terms and conditions for loans and borrowings during the COVID-19 pandemic has been tightened since it impacts the economy globally and domestically. Last but not least, total current liability is fluctuating between year 2018 and 2020, where there is materially increase from 38.9% to 40.3% in 2018 and 2019 respectively, and then materially decreased to 39.1% in 2020. These changes mainly due to a huge drop in other current liabilities. Ecoworld recorded 7.8% in 2018 and dropped to 0.5% in 2019 and 0.4% in 2020. This is because there is an increased amount from 36.9 million ringgit in 2018 to 48.9 million ringgit in 2019 and then decreased to 45.4 million ringgit in 2020 for unrealized income on transactions with joint ventures.
Next, for the SOPL item for the gross profit is decreased slightly from 21.7% in 2018 to 19% in 2019 and significantly dropped to 13.4% in 2020. This is due to the amount of cost of sales slightly increased from year to year. As we can see in the vertical analysis, the cost of sales is slightly increased from 78.3% in 2018 to 81% in 2019 and 86.6% in 2020. So it shows that the increase of cost of sale in 2020 is not in line with the decrease of sale in the year 2020. The increasing in cost of sales mainly due to the inventory recognized as cost of sales amounted to 1.8 billion in 2019 and 1.6 billion in 2020. The cost of inventories of the group recognized as an expenses in cost of sales during the financial year, representing write-down of inventories. So overall, the gross profit in 2020 is lower than in 2019, mainly due to the closure of sales galleries during the MCO, the temporary cessation of site activities from mid-March to mid-June, and the cumulative impact of inventories written down in the second half of 2020. Next, we move to the operating profit of Ecoworld Development. So, operating profit is decreased significantly from 9.2% in 2019 to 5.6% in 2020. Perhaps the decreasing of administrative and other expenses, selling and marketing expenses, and also increasing of other income. This is basically due to the amount of revenue drop in 2020, while the percent of cost of sales increases, which indirectly decreased the operating profit. So revenue in 2020 was lower as recognition was hampered by the MCO, which required all of the group's sales galleries to be closed from 18 March to 3 May 2020, which severely impacted the conversion of bookings into sales during the MCO period and activities on construction sites to be ceased from 18 March until mid-June 2020, with work permitted to resume thereafter subject to stringent COVID-19 measures being put in place. Next, we move to the expenses part. So as we can see in the vertical analysis, there is a slightly increase in administrative and other expenses from 9.5% in 2018 to 10% in 2019. So administrative expenses recorded a larger increase of 70% from previous year. This was mainly to support the higher level of activities undertaken by the group's Malaysian joint ventures, which enable substantially higher share of profits to be recorded in 2019. The higher depreciation charge following completion of the Century Mall January 2019 also contributed to the overall increase in administrative expenses. As for 2020, we can see that there is a slightly decrease for administrative and other expenses from 10% in 2019 to 8.7% in 2020. And for selling and marketing expenses from 2.1% in 2019 to 2% in 2020. This is due to the cost-saving measure implemented, resulting in a substantial reduction of in selling, marketing, and administration expenses as compared to 2019, contributed to the operating profit achieved. Okay, now we see in terms of profit. So in terms of profit before tax, there is a slightly increase from 10% in 2018 to 10.8% in 2019 and moderately decreased to 8.5% in 2020. So overall, the group's profit before tax in 2020 was lower than 2019, mainly due to the write-down in inventories totaling 98.8 million in 2020, following a detailed review of residual unsold stock within pieces that have been handed over. So lastly, in terms of profit for the financial year, analysis above shows the fluctuation of Ecoworld Development Group Berhad's profit. Ecoworld's profit for the financial year slightly increased from 7.6% in 2018 to 8.3% in 2019 and decreased to 6.8% in 2020.
Now let's move to ratio analysis. For the efficiency ratio, we can see there is slightly increase for account receivable turnover from 2.9 times to 3.13 times in 2018 and 2019 respectively, and decrease to 2.54 times in 2020. This shows the efficiency of Ecoworld in collecting the debts owed is in year 2020. Next, the inventory turnover is decreasing from 20.59 times to 1.42 times in 2018 and 2019 respectively, and continued declining to 0.74 times in 2020. This can be concluded that Eco outperformed and replaced depleted inventory quickly in year 2018. Last but not least, there is an increased ratio for total assets turnover from 0.21 times to 0.23 times in 2018 and 2019 respectively, and declined to 0.19 times in 2020. This shows that Ecoworld has the most efficiency in generating revenue from its assets in 2019.
We move to profitability ratio. So for the first one is net profit margin. It is a profitability ratio used to calculate the percentage of profit a company produces from its total revenue. It also reflects the amount of net profit a company obtains per ringgit of revenue generated. So potential distortion can be caused by other income and other expense item from net income, as these do not relate to the net sales. Based on the analysis, it shows that Ecoworld's net profit margin in 2018 is 7.62%, slightly increased to 8.26% in 2019 and continued to decrease to 6.77% in 2020. This indicates that Ecoworld's efficiency in converting its sales into profit is low in current year 2020 and high during financial year 2019 compared to others. Therefore, in 2019, Ecoworld indicates better income to shareholders because of its higher ratio in that year, while slightest income to shareholder in the year 2020. Next, for the return on investment ratio, these are used to measure income earned and invested capital and how well the firm utilizes its asset base. Return on investment ratio also evaluates enterprise performance without regard to financing sources. On the other hand, ROI also used to calculate the benefit an investor will receive in relation to their investment cost. So based on the analysis, it shows that there is a fluctuation of Ecoworld's ROI. In 2018, ROI recorded is 5.2%, slightly increased to 6.38% in 2019, and moderately dropped to 4.28% in 2020. This indicates that Ecoworld's ROI in 2019 is the highest compared to 2020 and 2018. So overall, ROI for 3 years are in positive figures, which indicates that Ecoworld returns are higher than its cost of investment. So for the third ratio under profitability is ROA, return on asset. It is measured how efficiently a company can manage its asset to produce profit during a period. Companies with a low ROA usually have more assets involved in generating profit, while companies with a high ROA have fewer assets. ROA is shown as a percentage, and the higher the number, the more efficient a company's management is at managing its balance sheet to generate profit. So based on the analysis, the ROA for Ecoworld Development shows the highest ratio in 2019 at 1.9%, and the second highest is in 2018 at 1.59%, while the lowest is in 2020 at 1.31%. Therefore, it indicates that Ecoworld's management managing its balance sheet to generate profits more efficiently in 2019 compared to 2018 and 2020.
Okay, next we move to the return on equity or ROE. ROE is a ratio that informs investor about how the business manage the money invested by the shareholders. The greater the ratio is more efficient for the firm management in creating income and growth from its equity financing. Compared to these 3 years, during year 2019, Ecoworld performed the highest return on equity, which is 4.48%, then 2018 3.76%, and 2020 2.89%. From 2018 to 2019, it showed an increasing of 0.72% in the return of equity, and in 2020, the return on equity goes down by 1.59% compared to 2019. This may caused by the pandemic COVID-19 that has given impact to the economy worldwide. It indicates that the company cannot generate more income during the year due to the restriction imposed by the ministry in order to cure the pandemic COVID-19. After paying for the direct cost of conducting this business, which can include labor, supplies, and other direct production costs, a company gross profit margin is what it makes. A company ability to sell its inventory profitability is determined by this ratio. It is better if the ratio is higher. During 2018, Ecoworld recorded the highest gross profit margin, which is 21.69%. But during the year 2019, the gross profit margin has slightly decreased from 21.69% to 19.07%. And in 2020, the gross profit margin become more decreased. It decreased by 5.67%. It indicates that the Ecoworld's ability to sell its inventory is not good during these 3 years, since a good gross profit margin is between 50 to 70%. Next, we go to the leverage ratio. We have 3 types of ratio under leverage ratio, which are debt ratio, debt to equity, and time interest earned. Okay, we go to the debt ratio. Debt ratio is to determine the percentage of a company asset financed by the creditor. Thus, the lower the ratio, the less risky it is, while a high ratio suggests that a company may be at a risk of default on loan if the interest rate suddenly rise. Ecoworld face slightly changes in debt ratio from 2018 to 2020. In 2018, the debt ratio for Ecoworld is 57.72%, and it decreased to 57.54% in 2019. After that, in 2020, the debt ratio decreased again by 2.66%. This shows that the Ecoworld have lesser risk over the past 3 years and lesser asset financed by creditor. We move to the second one, which is debt to equity. Debt to equity tells how much a company is financing its operation through debt versus wholly owned funds. Also, a higher rate indicates that the more creditor financing is used than the investor financing. If the cost of debt financing overweight then the income generated, the share value may be declined. During these 3 years, in 2020, the Ecoworld have the lowest debt to equity ratio of 121.66% compared to 2019, 135.53%, and 2018, the debt to equity ratio is 136.53%. Even it is just a slightly decrease in the ratio from 2018 until 2020, it's still good for the Ecoworld's performance. It indicates that the company used less creditor financing in 2020 compared to 2018 and 2019. The last ratio in leverage ratio is time interest earned. Time interest earned ratio measure a company ability to service its interest expenses obligation based on its current operating income. Time interest earned calculate the proportionate amount of income that can be used to cover the interest expenses in the future, and higher ratio are less risky. In 2020, the ratio value is amounting 1.81 times, while for both in 2018 and 2019, the ratio value share the same amount of 2.61 times. Compared to 2020, in 2019 and 2018 are less risky than 2020, since the time interest earned in 2020 is lower. It will increase the risk that the company could face in order to cover the interest expenses. And lastly, we have a liquidity ratio. We have 3 types of ratio under liquidity ratio, which are current ratio, asset test ratio, and cash ratio. We go to the current ratio first. Current ratio calculate a company ability to pay off its short-term liability with its current asset. A current ratio with less than 1 indicates that the company have problem in meeting its short-term obligation. In 2018, Ecoworld record the highest current ratio with the ratio value of 1.07, where it shows that the Ecoworld are able in meeting their short-term obligation since the ratio is more than 1, which it indicates that they have successfully moved to secure position, and finally their current asset able to pay off their short-term liabilities. But in 2019 and 2020, Ecoworld shows slightly difference in the current ratio within 3 years. From 2018 to 2019, it decreased by 0.09, while in 2019 it was 0.98 and then decreased to 0.85 in 2020. Next, asset test ratio. The asset test ratio compares a company's most short-term asset to its most short-term liability to see if a company have enough cash to pay its immediate liability. Generally, the higher the ratio, the greater the company liquidity. During the year of 2018, Ecoworld recorded the highest asset test ratio with the value of 1.03, where it shows that the Ecoworld have a high liquidity cash in order to pay their liabilities, which it indicates that they have enough cash. But in 2019 and 2020, Ecoworld shows slightly differences in the current ratio within 3 years. In 2018, it was 1.03 and then decreased to 0.37 in 2019, while from 2019 to 2020 it has slightly decreased by 0.02, and it shows that the company have low liquidity of cash to pay back their liabilities. And lastly, cash ratio. The liquidity of a company is gauged by the cash ratio. It particularly determines the proportion of current liability to total cash and cash equivalent held by a company. The indicator assesses a company's capacity to pay off its short-term debt with the cash or resources that can be converted into cash quickly, including readily tradable securities. In 2018, the cash ratio for Ecoworld is amounting to 0.13, but then it increased slightly to 0.14 in 2019. However, in 2020, it decreased by 0.03 from 2019. From the observation, the cash ratio for these 3 years is less than 1. It indicates that the Ecoworld have more current liability compared to cash and cash equivalent. It shows that the company did not have sufficient cash on hand to pay their short-term debt.
Next, we move on to the short-term future prospects. Firstly, Ecoworld are expected to have a better future performance due to opportunities. This is because Ecoworld have the competitive advantages and they also able to offer their properties to certain market segmentation. Not only that, they also have the capability to maximize the utilization of resources. When MCO is lifted, they will have unrestricted businesses operation hours. Next, they also need to set target sales higher than the actual sales in the previous year. These sales targets can be achieved by concentrating on the larger and more resilient M40, Gen Y and Gen Z customer groups. Not only that, they also can actively promoting their properties to the local and foreign industrialists. From the aspect of influence by external factors, the government also contributes to a better performance of the Ecoworld. The attractive tax and incentives offered by the government are able to attract business to set their business operations. These incentives will reduce the tax payments since it provides tax relief for the COVID-19 expenses. And also lastly, from the aspect of the digitalization, Ecoworld need to use new digital technology in the future. This is because the implementation of digitalization will able to result in both time and resource cost savings and improve efficiency. For example, the financial loan application and approval can be tracked closely by using this digital technology. To conclude, from the industry analysis, we choose to make SWOT analysis to help Ecoworld to make strategic plan and decision. The SWOT analysis comprises of strengths, weaknesses, opportunities and also threats. The details of the SWOT analysis for Ecoworld had been explained by Sarah in slides 4. From the financial analysis, we can conclude that the profitability ratio of Ecoworld are not in good condition. Therefore, to improve their profitability ratio, Ecoworld need to boost their sales in order to enjoy more profit, which will increase the return on investments, as well as enhancing the value of the company. And also, for the liquidity ratio shows that Ecoworld did not have sufficient cash flow to pay back their debts. To improve their liquidity, they may discuss with bank to restructure the loan terms by extending the payment terms. By having longer period of time, Ecoworld are able to obtain adequate cash to repay its debt. Meanwhile, for the efficiency ratio, it shows that Ecoworld have a good strategy in collecting their debts owed. The receivables must have a good turnover since it will affect the level of credit risk of the company. For Ecoworld, the usage of the new digital technology are able to improve their business efficiency.